Before we begin, please note that the information provided in this presentation is for educational and informational purposes only. It does not constitute financial, legal, or insurance advice. We are not licensed financial advisors or insurance agents. The experiences and reviews discussed are based on publicly available data and customer-submitted testimonials. Your own experience with any insurance company may vary. Always conduct your own thorough research and consult with a qualified professional before making any financial decisions. You get the envelope in the mail. It's thin, unassuming, but you know exactly what it is. It's your car insurance renewal. You feel that tiny knot form in your stomach as you tear it open. And there it is. Your premium went up. Again, by $50, maybe $100 a month. For no good reason. You haven't had an accident. You haven't gotten a single ticket. Your car is a year older, it's worth less, yet somehow you're expected to pay more. It's a feeling of complete helplessness, like you're being squeezed just because they can. So you do what any of us would do. You grit your teeth, open your laptop, and you start searching. Cheap car insurance. Affordable auto insurance. And that's when you see them. The ads for a company called Direct Auto Insurance. The promises are bold. The prices seem almost too good to be true. They talk about low down payments, flexible options, and getting you covered today, no matter your history. And the thought crosses your mind. Could this be the answer? Could this be how I finally stop overpaying and put that $100 a month back in my own pocket? But then a different kind of feeling creeps in. A little bit of skepticism, a little bit of doubt. We've all been taught that you get what you pay for. So what's the catch? If you're paying significantly less, what are you giving up? Is the customer service a nightmare? Will they actually be there for you if, God forbid, you actually need them? Because the cheapest insurance in the world is the most expensive one you can buy if it doesn't pay out when you have a claim. That is the exact question we are going to answer today. We've spent the last several weeks doing a massive deep dive into direct auto insurance. We're not just scratching the surface. We've sifted through hundreds upon hundreds of real, verified reviews from customers all across the United States. We've analyzed complaint data from the Better Business Bureau and the National Association of Insurance Commissioners. We've read the fine print in their policy documents so you don't have to. We are not sponsored by them. We are not affiliated with any insurance company. Our only goal is to give you the unvarnished, unfiltered truth, directly from the mouths of the people who pay them every single month. We're going to give you the good, the bad, and the downright ugly so that by the end of this video, you can make an informed decision for yourself. We're going to break down exactly who Direct Auto is built for, because they have a very specific niche. We're going to talk about their pricing and why it can be so much lower than the big names. Then we're going to get into the heart of it all, the claims process. We'll expose the number one, most frequent complaint that appears over and over again like a warning flare. We'll share the story of a driver from Georgia whose $1,500 claim turned into a 6-month battle. And we'll also share the story of a young driver from Arizona who says Direct Auto was the only company that would give him a second chance, and who came through for him when it mattered most. This is the complete picture. So let's start with the big one. The reason anyone even considers Direct Auto in the first place, the price. Who are they for? To understand Direct Auto, you have to understand that they are not trying to be State Farm or Progressive. They are not competing for the perfect driver with an 800 credit score and a spotless record. Their bread and butter, their entire business model, is built around serving drivers that other insurance companies often turn away or charge an absolute fortune to cover. We're talking about drivers who might need in-state Route 22 filing. If you've had a major violation like a DUI or driving without insurance, the state might require you to have your insurance company file an State Route 22 form to prove you have coverage. It's a headache, and many standard insurers don't want to deal with it. Direct Auto specializes in this. For many people in this situation, they are a lifeline to getting their license back and getting back on the road legally. They also cater heavily to drivers with less than perfect credit. In most states, your credit score has a massive impact on your insurance premium. The industry calls it an insurance score, but it's largely based on your credit history. If you've had financial struggles, big companies can penalize you harshly, even if you're a great driver. Direct Auto puts less emphasis on this, opening the door for people who are being priced out of the market simply because of their financial history. And of course, there are drivers with a spotty driving record. A couple of speeding tickets, an at-fault accident from a few years ago. For the big-name companies, these are red flags that send your rates into the stratosphere. Direct Auto is far more forgiving of these past mistakes. Their entire model is based on taking on this higher perceived risk. They also heavily market flexible payment options and low down payments, which is a huge deal for someone living paycheck to paycheck who can't afford to drop $500 just to get a policy started. Let's put a face to this. Think of someone like David. A composite of many reviews we read. David is a 24-year-old in Florida. A few years ago, he made a mistake and got into an at-fault accident. His previous insurer jacked his rates up to over $400 a month. It was crippling. He was considering selling his car because he couldn't afford the insurance to drive to his construction job. He shopped around and every quote was astronomical. The big companies saw him as a massive liability. Then he got a quote from Direct Auto. It was about $180 a month. For David, this wasn't just a good deal. It was the difference between keeping his job and losing it. He signed up on the spot, was able to make a low down payment, and was back on the road legally within an hour. For thousands of Davids across the country, Direct Auto is not just a cheap option. It's the only option. It's the company that says yes when everyone else says no. They provide a vital service for a huge segment of the population that is underserved by the mainstream insurance market. The reviews from these customers are often glowing. They praise the easy sign-up process, the affordable rates, and the feeling of relief that comes with finally finding coverage they can actually afford. They talk about friendly agents in the local offices who help them navigate the confusing State Route 22 process and treated them with respect, not judgment. So if you fall into one of these categories, if you need in State Route 22, have some dings on your driving record, or are struggling with your credit, the initial appeal of Direct Auto is undeniable. On paper, it looks like the perfect solution, a company built specifically for your situation. But here is the critical pivot point. Here is where the story splits into two completely different realities. The experience of signing up for Direct Auto and paying your bill is one thing. The experience of needing them to hold up their end of the bargain after an accident, well, that's where things get incredibly complicated. It's where the 5-star reviews for great prices suddenly get buried under an avalanche of 1-star reviews screaming about the claims process. It is the fundamental conflict at the heart of this company. What happens when the rubber actually meets the road? What happens when you pick up the phone, your hands shaking after a crash, and you have to say those words, "I need to file a claim?" Because that single phone call is where a happy customer can transform into an absolute nightmare. And it's what we need to explore next. That moment of truth, when the adrenaline is still pumping and the sound of crunching metal is echoing in your ears, is the single most important test of any insurance company. It's where the promises made in those friendly commercials either become a comforting reality or a cruel, expensive joke. And when we dig into the real-world claims experiences of Direct Auto customers, we find a story of two completely different companies. First, let's talk about the company you hope you're paying for. Let's call her Jennifer, a single mom from Memphis, Tennessee. She's driving her 7-year-old sedan home from her second job when someone, distracted by their phone, blows through a stop sign and clips her rear bumper. It's not a catastrophic accident, but it's enough to spin her car, shatter her nerves, and make her car undrivable. She's shaken but thankfully unhurt. After the police leave, she pulls up the Direct Auto app. She takes a few pictures of the damage, uploads the police report number, and answers a few questions. Within an hour, she gets a call from a claims representative. The person on the other end is calm and empathetic. They ask if she's okay, walk her through the next steps, and confirm the other driver was at fault. By the next morning, a tow truck has picked up her car, and Direct has already arranged a rental for her, covered by her policy. 2 days later, an adjuster calls with a clear, fair estimate for the repairs. The check is sent directly to the body shop she chose. 3 weeks later, she's back in her own car. The whole ordeal a bad memory, but one where her insurance company did exactly what it promised. She leaves a 5-star review online, praising their efficiency and customer service. This is the best-case scenario. This is the experience that makes you feel like your monthly premium is money well spent. And to be fair, these stories exist. There are customers who have a smooth, painless claims process with Direct Auto. But for every Jennifer, there seems to be a Mark. Mark, a construction worker from Dallas, Texas, gets rear-ended on the highway during his morning commute. The damage is significant. The other driver's insurance is already admitting fault. It should be simple. Mark calls the Direct Auto claims number. He's on hold for 45 minutes. When he finally gets through, he explains the situation to an agent who sounds rushed and disinterested. They take his information and tell him an adjuster will be in contact within 24 to 48 hours. 48 hours go by. Nothing. He calls back. He's on hold for another 30 minutes. He gets a different agent who seems to have no record of his first call. He has to explain everything all over again, the frustration rising in his voice. This new agent gives him a claim number and the name of his assigned adjuster, a Mr. Henderson. Now Mark begins what so many negative reviews describe as the communication black hole. He calls Mr. Henderson. It goes straight to a full voicemail box. He tries again the next day. Voicemail. He leaves a message. No call back. He sends an email. He gets an automated reply. Days turn into a week. Mark is now paying for a rental car out of his own pocket because his policy didn't include rental coverage, and he needs to get to work. The body shop where his truck was towed is calling him, asking for the insurance information so they can start the estimate. Mark has nothing to give them. He calls the main claims line again, desperate. He's told that only his assigned adjuster, Mr. Henderson, can authorize the estimate. Can you transfer me to him? Mark asks. He doesn't have a direct line, they say. Can you have him call me? We'll send him a message, they reply. This cycle repeats for 3 weeks. Voicemails, unreturned emails, and calls to a general hotline that lead nowhere. Mark feels completely powerless. He is paying a company to protect him, and in his moment of need, they have built a fortress of bureaucracy around his claim, and his adjuster is a ghost. He's losing money on the rental, he's at risk of storage fees from the tow yard, and his stress is through the roof. Finally, after threatening to file a complaint with the Texas Department of Insurance, he gets a call. The process finally begins, but the damage is done. The trust is shattered. He feels like he had to fight his own insurance company just to get them to do their basic job. This story, this pattern of delay and decay in communication, is the single most common complaint leveled against direct auto. But it gets worse. Because a slow process is one thing. A deliberately unfair one is something else entirely. Consider the story of Maria, a retiree in Florida. Her car, which she owns outright, is her lifeline. It takes her to doctor's appointments and to visit her grandkids. One afternoon, a pickup truck runs a red light and T-bones her in an intersection. Her car is completely totaled. The other driver is clearly at fault, a fact stated in the police report. The initial part of the claims process with Direct is surprisingly quick. They declare the car a total loss within a week. Maria is relieved. She thinks the worst is over. Then she gets the settlement offer. It's for $4,500. Maria is stunned. She knows her car was in excellent condition. She had just put new tires on it. Kelley Blue Book suggests a private party value of closer to $8,000. Even the lowest trade-in values are around $6,000. She starts looking at used car listings online and finds that she can't find a single car comparable to her old one for less than $7,500. The $4,500 offer isn't just low. It's impossible. It won't allow her to replace her vehicle and get back to her life. So she calls her adjuster. The adjuster explains that they use a third-party company to generate a market valuation report. Maria asks for the report. When she receives it, her heart sinks. The comparable vehicles the report is based on are from 3 states away. One has a salvage title. Another has 50,000 more miles than her car did. It's a report that seems designed to produce the lowest possible number. Maria pushes back. She sends the adjuster links to 5 different cars for sale within a 50-mile radius of her home, all priced between $7,000 and $8,000, proving the actual market value. The adjuster's response is cold. This is the valuation from the report. This is the offer. The tone has shifted. It's no longer a partnership. It's an adversarial negotiation. Maria, an elderly woman on a fixed income, is now in a battle of wills with a multi-million-dollar corporation. Every day that goes by, she is without a car. Every phone call is a draining, stressful experience. The company knows this. They know that many people, faced with this kind of resistance, will eventually give up. They'll take the lowball offer out of sheer exhaustion and desperation, because they just need a check to put towards a down payment on another car. This is the most damning accusation found in customer reviews. The feeling that the company isn't just incompetent, but that it is actively and strategically trying to underpay your claim, using delays and junk data as weapons to wear you down. So we have 3 stories: the smooth and easy promise, the frustrating and neglectful reality, and the downright predatory nightmare. The positive reviews praise the price and, in some cases, a smooth claims process. But the negative reviews all circle the same drain. A claims department that is unresponsive at best and adversarial at worst. It's a pattern of behavior that suggests a systemic issue. So why does this happen? Is it just a few bad adjusters, a broken system? Or is it something deeper? Is there something baked into the business model of an insurer that primarily serves the non-standard market? A model that relies on low premiums to attract customers? Because the answer to that question reveals the fundamental trade-off you might not even realize you're making. It's a trade-off between your monthly payment and the actual tangible value of your policy. And it all comes down to one critical document that almost nobody reads, until it's far too late. We're going to break down that document next. That document is your insurance policy's declaration page. It's usually the first 1 or 2 pages of the massive, unreadable packet they mail you or the PDF you download once and never open again. We call it the deck page. And it is, without exaggeration, the single most important piece of paper in your entire insurance relationship. It's the contract. It's the blueprint of what you are actually buying. Every promise, every limit, every dollar figure that matters when your world turns upside down is printed right there in black and white. And the reason so many people end up with a horror story review is because they focused on the price quoted over the phone, but never truly understood the promises written on this page. So let's do what almost no one ever does. Let's pull out a hypothetical direct auto insurance declaration page and translate it from confusing insurance speak into plain, simple English. We're going to find out where the value is and where the traps are hidden. Right at the top, you'll see the basics: your name, your address, the policy number, and the policy period. That policy period is critical. It'll show the exact date and time your coverage starts and ends. Let it lapse even by 1 day and you are driving completely exposed. Insurers see a lapse in coverage as a major red flag, and your rates can skyrocket when you try to get a new policy. Below that, you'll see the listed vehicles and drivers. This seems simple, but it's the first potential pitfall. Is every licensed driver in your household listed? Is your teenager who just got their permit on there? If someone who lives with you but isn't on the policy wrecks your car, the insurance company could have grounds to deny the claim entirely. They'll argue they never agreed to cover that risk because they never knew about it. Okay, now we get to the heart of it. The section called Coverages. This is the menu of protections you've purchased, and it's where a cheap policy reveals its true cost. It's usually a chart with a bunch of terms and a column of numbers next to them. Let's break down the most important ones. First, liability. This is the one coverage that's legally required in almost every state. It doesn't cover your car or your injuries. It covers the damage you do to other people and their property. You'll see it written as 3 numbers, like 25/50/25. This is where the budget-focused model of a company like Direct Auto can become incredibly dangerous. That 25/50/25 represents thousands of dollars. The first number, 25, means your policy will pay up to $25,000 for any single person's medical bills you injure in an accident. The second number, 50, means your policy will pay a maximum of $50,000 for all medical bills for everyone you injure in a single accident combined. And that last number, 25, means your policy will pay up to $25,000 for the property damage you cause. Now let's be brutally honest. Those numbers are the state-mandated minimums in many places. They are the absolute legal bare minimum you can have to avoid a ticket. And in 2024, they are terrifyingly low. Think about it. You accidentally run a red light and T-bone a brand new minivan with a family inside. One person has a broken leg and needs surgery. Their medical bills fly past $25,000 before they even leave the hospital. Your insurance pays the $25,000, and guess who's getting a letter from their lawyer for the rest? You. What if you cause a multi-car pileup? Your policy maxes out at $50,000 for everyone's injuries combined. That's gone in a flash. And the property damage? $25,000? The average price of a new car in the United States is over $48,000. If you so much as dent the bumper of a new Tesla, a BMW, or even a fully loaded Ford F-150, that $25,000 is going to evaporate. And again, you are personally on the hook for the difference. Your savings, your assets, your future wages could all be at risk because you saved a few bucks a month on a state minimum policy. This is the #1 reason for negative reviews that say, they didn't cover everything. The policy did exactly what it was sold to do. The problem was that the policy itself was woefully inadequate for the realities of the modern world. Next on the list, You might see uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. This is one of the most important coverages you can have, and it's often one of the first things people decline to save money. This coverage protects you when the person who hits you either has no insurance at all, or they have one of those cheap state minimum policies we just talked about. 1 in 8 drivers in the US is uninsured. In states like Mississippi and Florida, where direct auto has a huge presence, that number is closer to 1 in 4. This coverage pays for your medical bills and your passengers' medical bills if you're hit by one of those drivers. Without it, you're relying on your own health insurance, or worse, you're left to pay out of pocket, hoping to sue a person who couldn't afford insurance in the first place. Then we have what many people call full coverage. But that term is dangerously misleading. There is no such thing as full coverage. What people mean are 2 separate coverages: collision and comprehensive. Collision coverage pays to repair or replace your car if you are in an accident with another object. Another car, a pole, a guardrail, a tree. It doesn't matter who is at fault. If you collide with something, this is the coverage that fixes your vehicle. Comprehensive coverage, on the other hand, pays for almost everything else. Think of it as acts of God or non-collision events. A tree branch falls on your car during a storm. Your car is stolen. A deer runs out in front of you. A rock cracks your windshield. Vandalism. Floods. Hail. All of that is covered under comprehensive. Now, here's the most critical part of collision and comprehensive: the deductible. You'll see this number listed right next to the coverage, usually $500, $1,000, or even $2,000. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single penny. A higher deductible means a lower monthly premium. And this is a classic lever used to make a policy look cheap. A quote with a $2,000 deductible will look much more attractive than one with a $500 deductible. But you have to ask yourself a hard question. If you got into an accident tomorrow, could you comfortably write a check for your deductible amount? If the answer is no, then your insurance is functionally useless. We've seen reviews from customers who were thrilled with their low monthly payment, only to realize after a crash that they couldn't afford the $1,500 deductible to even start the repairs. Their car just sat there, wrecked and undrivable, while they scrambled to come up with the cash. The cheap premium became the most expensive policy they ever had. Finally, look for any special additions or exclusions. Do you drive for Uber or DoorDash? Standard personal auto policies will not cover you while you're working. You need a special edition called a rideshare endorsement. Do you have expensive custom rims or a high-end stereo system? That's likely not covered unless you have a custom parts and equipment endorsement. The declaration page is the summary, but the full policy booklet, that dense 50-page document, contains all the fine print, all the what-ifs and but not ifs. So when you're looking at that quote from Direct Auto or any insurer, don't just look at the price. Look at the declaration page. Look at the liability limits and ask yourself if they're enough to protect your family's financial future. Look at the deductibles and ask if you can truly afford them. Understand what you are declining and what risk you are accepting by doing so. Because the promises made on this single piece of paper are all that will stand between you and financial disaster when the worst happens. Now you understand the policy. You've read the contract, you've chosen your coverages, and you feel protected. But a policy is just a promise on paper. The real test, the moment of truth that makes or breaks an insurance company's reputation, comes when you actually have to use it. It comes when you're standing on the side of the road, heart pounding, glass on the pavement, and you have to make that dreaded phone call. What happens next? That's when you enter the world of the claims process. And the person you'll be talking to, the claims adjuster, their job, their goal, and their incentives are probably not what you think they are. We're going to expose the reality of the claims process next. So when you file a claim, you're assigned an adjuster. And in your mind, this person is your guide, your ally, the one who's going to help you put the pieces back together. That assumption is the first and most critical mistake you can make. The claims adjuster does not work for you. They may be friendly, they may be empathetic, they may say all the right things, but their primary number one, non-negotiable loyalty is to their employer's bottom line. Their job is not to pay you what your claim is worth. Their job is to close your claim for the lowest possible amount that you will accept. They are, in essence, professional negotiators trained in the art of minimizing payouts. And they have a playbook. A very specific, very effective playbook they use time and time again. The very first move in that playbook is almost always the recorded statement. Right after the accident, you'll get a call. The adjuster will be incredibly sympathetic. "I'm so sorry this happened to you. I just need to get a quick recorded statement to understand the facts, so we can get this moving for you." Sounds harmless. It sounds procedural. It is a trap. Let's look at a review from a customer named Brenda in Tennessee. She had what seemed like a straightforward rear-end collision. She was stopped at a red light, and a direct auto customer hit her from behind. Clear cut, right? During the recorded statement, the direct adjuster asked her, "So just before the impact, were you looking in your rearview mirror?" She said no, she was looking at the light. A few weeks later, they tried to assign her 20% of the fault, arguing that if she had been paying attention to her mirror, she might have been able to take some evasive action. It's a completely absurd argument, but that one innocent-sounding question, answered honestly, gave them an opening. They are not asking questions to help you. They are fishing for any word, any phrase, any hesitation they can twist to assign you partial blame and reduce their payout. Another customer, David from South Carolina, mentioned in his review how the adjuster kept rephrasing the same question about his speed. "Were you going the speed limit? Were you certain you weren't going even 1 mile over? Could you have been distracted by the radio?" David said it felt less like an interview and more like an interrogation. The goal is to get you to say something inconsistent, to express doubt, to use words like "I guess" or "I think." Those words become ammunition used against you later. The cardinal rule is this: you are often not legally obligated to provide a recorded statement to the other person's insurance company. You can, and often should, politely decline. The next page in the playbook is the delay game. Insurance companies know that you are in a vulnerable position. Your car is wrecked. You might be missing work. You have medical bills piling up. You need a resolution, and you need it now. They have all the time in the world. Time is leverage. And we see this tactic mentioned constantly in reviews about direct auto. Take this one from a user named Frustrated and Phone Travel. "It's been 6 weeks. 6 weeks since my car was totaled. Every time I call, my adjuster is in a meeting or out of the office. I've left a dozen voicemails. I get one email back a week with a vague update like, 'We're still reviewing the file.' Meanwhile, I'm paying for a rental car out of my own pocket because they're dragging their feet. It feels like they're trying to make me so desperate that I'll just accept whatever garbage offer they eventually throw at me. This isn't an accident. It's a strategy. Every day they delay is another day you feel the financial pressure mounting. It weakens your resolve. They know that eventually, many people will hit a breaking point and accept a lowball offer just to make the nightmare end. They switch adjusters mid-claim, forcing you to start over and explain everything to a new person who has no idea what's going on. They lose documents you sent them. They request the same police report 3 different times. It is a war of attrition, and they are masters of it. When they finally do make an offer, especially on a totaled vehicle, you encounter the next chapter of the playbook, the black box valuation. They don't just pull a number out of thin air. They use third-party valuation software, often a system called CCC1, to generate a report that justifies their low offer. A review from Marcus in Texas breaks this down perfectly. "Direct Auto offered me $8,000 for my Honda Accord. I knew that was low. I couldn't find a similar car for less than $11,000 anywhere. I asked for their valuation report. They sent me this 20-page document from a company called CCC. The comparable vehicles they used to justify the price were base models with high mileage from 200 miles away, while mine was a fully loaded, low-mileage model. They even had a condition adjustment that knocked off $1,200 for pre-existing wear and tear on a car that was in pristine condition. It's a complete scam, designed to look official and intimidate you into thinking the number is non-negotiable. And Marcus is exactly right. These reports are designed to be confusing and authoritative. They are the company's proof that their offer is fair, when in reality, the data and the comparables are often cherry-picked to produce the lowest possible value. They are betting on the fact that you won't read the fine print, that you won't challenge the comparable vehicles, and that you won't do your own research to find out what your car is actually worth on the open market. They present their offer not as a starting point for negotiation, but as a final, data-driven conclusion. It's pure psychological manipulation. But perhaps the most insidious tactic, the one that causes the most emotional and financial damage, is how they handle injuries. If you tell the adjuster you were hurt in the accident, a switch flips. Now they aren't just trying to save a few $1,000s on a car. They are trying to limit their liability on a medical claim that could be worth tens or even hundreds of thousands of dollars. The friendly facade often evaporates. Listen to this harrowing experience from a woman named Sarah in Georgia. The day after the accident, the direct adjuster called me. I told him my neck and back were really hurting and my doctor recommended physical therapy. The adjuster's tone changed instantly. He said, "Ma'am, the photos of your car only show minor bumper damage. A collision at that speed is unlikely to cause the kind of injuries you're describing." He basically called me a liar 24 hours after I was in a traumatic accident. For the next 3 months, he fought me on everything. He demanded every single medical record I've had for the last 10 years, looking for a pre-existing condition he could blame. He refused to approve the physical therapy my doctor ordered. It was humiliating and unbelievably stressful. I felt like a criminal for being injured. This is a classic deny, delay, defend strategy. They deny the severity of your injury. They delay approving necessary treatments, hoping you'll give up or that a gap in your treatment will allow them to argue the injury wasn't serious. And they defend their position aggressively, using their own paid medical reviewers to contradict your doctor's diagnosis. They are turning a physical injury into a question of your personal integrity. They are forcing you to prove you are in pain, to justify your need for care, all while you're supposed to be focusing on recovery. It is a brutal, exhausting process that breaks people down. From the recorded statement to the delay tactics, from the rigged valuation reports to the aggressive questioning of your injuries, this is the reality of the claims process. It is not a customer service interaction. It is a high-stakes negotiation where you are the underdog. You are one person, likely unfamiliar with the process, dealing with trauma and financial stress. They are a multi-million-dollar corporation with a team of experienced professionals who do this every single day. They know the playbook inside and out because they wrote it. So you see the tactics. You understand the strategy. You refuse the recorded statement. You document every delay. You reject their lowball offer and come back with your own evidence of what your car is worth. You stand firm on your injuries. You decide to fight. What happens then? That's when the insurance company decides to stop playing games and brings out their final line of defense, the department that's even tougher, even more ruthless than the adjusters. And what they do next can change everything. They're called the Special Investigations Unit, or SIU, and their name tells you everything you need to know. They aren't there to investigate how to pay your claim. They're there to investigate you. Their one and only job is to find fraud, deception, and misrepresentation. They are the company's internal detectives, and when your file lands on their desk, you are no longer a customer. You are a suspect. Every single word you've ever said to them, every box you've ever checked on a form, becomes evidence in a case they are building against you. And they are masters at finding a reason, any reason, to deny your claim and, in some cases, to destroy your policy entirely. Take the case of Sarah, a 28-year-old graphic designer from North Carolina. For 5 years, she'd been a model customer for Direct Auto, paid her premiums on time every time. No accidents, no tickets. Then one rainy afternoon, she was waiting at a red light when a pickup truck, going way too fast for the conditions, slammed into her from behind. The damage was severe. Her car, a late-model sedan she was still making payments on, was declared a total loss. Her neck and back were injured, leading to weeks of physical therapy and missed work. The initial claim process was exactly what you'd expect. The adjuster was polite but firm, offering a settlement for her car that was thousands less than its actual market value. They used comparable vehicles that were older, had higher mileage, or were in poorer condition. Sarah knew her car was worth more. She did her homework. She sent them listings for identical cars in her area. She provided her maintenance records. She argued respectfully but persistently. She wasn't being greedy. She just wanted what was fair. Enough money to replace the car she had lost through no fault of her own. For the medical side, it was the same story. They questioned every single physical therapy session. They demanded mountains of paperwork. They implied that maybe she wasn't as hurt as she claimed to be. But Sarah stood her ground. She thought she was doing the right thing. She was fighting for what she was owed, and that was her mistake. Because by refusing to accept their lowball offers, she flagged herself in their system. She was no longer a simple, profitable claim to be closed. She had become a problem. And that's when her file was kicked upstairs to the SIU. A few weeks later, she got a letter in the mail. It wasn't from her friendly adjuster. It was from the Special Investigations Unit. The letter was cold, formal, and terrifying. It informed her that her entire policy was under review for material misrepresentation on her original application. Sarah was baffled. What could they possibly be talking about? She had been completely honest when she signed up 5 years ago. She called the number on the letter, and the SIU investigator who answered was a completely different breed from the customer service rep she was used to. There was no empathy in his voice. He was an interrogator. He informed her that on her original application, when asked where the vehicle would be primarily garaged, she had listed her parents' address in a quiet suburb. That was true. When she first got the car, she was living at home. But about a year later, she moved into an apartment in the city, about 20 miles away. She'd updated her mailing address with the company, of course. She'd never tried to hide it. But the investigator pointed out, she never specifically called to update the garaging address. To Sarah, this was an insignificant oversight, a clerical error at worst. To the SIU investigator, it was the smoking gun. He explained in a chillingly calm voice that the premium for a car kept in the city was higher than in the suburbs. By failing to update that specific detail, she had, in their eyes, been paying the wrong premium for 4 years. She had misrepresented a material fact. And because of that, they had the right to declare her policy void. Not just cancel it going forward. Void it from the beginning, as if it never existed. The implication was a punch to the gut. If the policy never existed, she wasn't insured on the day of the accident. This meant Direct Auto owed her nothing. Not for her totaled car. Not for her medical bills. Not for her lost wages. Zero. They would walk away and she would be left with a mountain of debt, a wrecked car, and no way to get to work. Then came the final brutal twist. The investigator offered her a one-time take-it-or-leave-it deal. If she agreed to drop her injury claim entirely and accept their very first, rock-bottom offer for her car, the one that was thousands below its value, and sign a release form absolving them of all future liability, they would consider not pursuing the policy voidance. It was a threat dressed up as an offer, a form of corporate blackmail. They had found a tiny procedural loophole and were using it as a sledgehammer to crush her legitimate claim. Sarah felt trapped. She had fought to be treated fairly, and in response, the company she had trusted for years was now threatening to financially ruin her. This wasn't a one-off case. This is a core tactic. The SIU's goal is to find leverage, and one of their favorite tools is the recorded statement. Sounds so innocent. After an accident, an investigator, often from the SIU, will call you. They'll be incredibly sympathetic. They'll say things like, "I just want to get your side of the story to help speed things up." Or, "We need this recording for our file to make sure you get paid quickly." It sounds like they're on your side. Feels like cooperation. It's not. It's a calculated ambush. Consider Michael, a construction worker from Florida. He was involved in a complex 3-car incident on I-95. It was chaos. Cars swerving, brakes screeching. It was impossible to know the exact sequence of events. The next day, an SIU investigator called him for a recorded statement. Michael, wanting to be helpful, agreed. The investigator started with easy questions, lulling him into a false sense of security. Then the questions became more pointed, more complex, and faster. "So you were in the left lane? And you saw the silver car merge? Did you see it before or after you first applied your brakes? Can you state with 100% certainty that you were maintaining the legally required following distance at the precise moment of the first impact?" Michael, trying to be honest, would answer as best he could. "I think so. I'm pretty sure. It all happened so fast." The investigator then asked, "Were you distracted at all before the crash? The radio? Your phone?" Michael honestly said, "No, not at all." The investigator pushed. "So your eyes were on the road 100% of the time for the full minute leading up to the accident? You never once glanced at your speedometer or your side mirror?" Michael, trying to be perfectly accurate, said, "Well, of course I glanced at my mirrors. You have to do that to drive safely." 2 weeks later, Michael received his denial letter. It was a masterclass in manipulation. The letter stated, "Per your recorded statement, you admitted you were not sure about your following distance." It also said, "Mr. Henderson admitted to taking his eyes off the road to look in his mirrors immediately before the impact." They had taken his honest, reasonable answers and twisted them into admissions of fault. His attempt to cooperate had been weaponized against him. The friendly chat was, in fact, a deposition he wasn't prepared for, where every word could and would be used to deny his claim. This is the new battlefield. When the SIU gets involved, you are no longer negotiating the value of a dented bumper. You are in a legal minefield and the other side planted all the mines. They scrutinize your application from years ago, looking for any inconsistency. They put you on a recorded line and ask leading questions designed to trip you up. They are not trying to find the truth. They are trying to build a case for denial. They are counting on you not knowing the rules of this new game. They're counting on you feeling intimidated, overwhelmed, and alone. They have you cornered, with the guillotine of policy cancellation hanging over your head. Feels like there's no way out. But they have a blind spot. There is something they don't expect you to do. There's a countermove so powerful it can stop them in their tracks and force them to completely reevaluate their strategy. This countermove is called the paper trail offensive. Sounds simple, almost too simple to be effective, but that's its genius. It's a strategy built on one undeniable principle. Large corporations, especially insurance companies, are terrified of clear, indisputable, written documentation. Their entire system of delay and deny is built on the murky, unrecorded, and deniable nature of phone calls. A phone call is your word against theirs. A phone call can be misinterpreted. A phone call leaves no evidence. A certified letter with a return receipt? That is a legal document. It is a cannonball of proof fired directly into their corporate headquarters, and they cannot pretend they didn't see it coming. Let me tell you about a customer from Cleveland, Ohio. We'll call him David. David was a model customer for Direct Auto, paid his premiums on time for 3 years, never had a claim. Then one afternoon on I-90, a driver runs a red light and T-bones his sedan. The other driver is clearly at fault. Police report confirms it. Everything is by the book. David files his claim, expecting a straightforward process. That's when his nightmare began. First, it was the endless hold times. Then it was the adjusters who never called back. He'd speak to a woman named Sarah on Monday who promised a check was being processed. On Thursday, he'd speak to a man named Mike who claimed he'd never heard of Sarah and that the claim was still under review. They asked him to submit the same photos 3 different times, each time claiming the previous set was lost in the system. Weeks turned into a month. David was paying out of pocket for a rental car. His own car was sitting in a tow yard racking up storage fees, and his stress was through the roof. He was trapped in their phone maze, a hamster on a wheel designed to wear him down until he'd accept any lowball offer they threw at him just to make it stop. He felt powerless. He was exactly where they wanted him. But then David decided to stop playing their game. He decided to change the rules. He launched the paper trail offensive. Here's exactly what he did, and it's a blueprint you can follow. First, he stopped calling them. Completely. He understood that every phone call was a battle on their home turf, where they had all the advantages. He refused to engage there any longer. Second, he sat down at his kitchen table and created a master document. He wrote down everything. His full name, address, and policy number at the top. The claim number in big, bold letters. Then, he created a meticulous timeline. Date of accident. Date the claim was filed. Then a bulleted list. Every single phone call he had made. He listed the date, the approximate time, and the name of the person he spoke to. Beside each name, he wrote a summary of what was said. Spoke to Sarah. She confirmed the estimate from my mechanic was received and said payment would be issued in 5 to 7 business days. Spoke to Mike. He stated there was no record of the estimate and I would need to resubmit it. Fact after fact after fact. No emotion, no anger. Just a cold, hard, undeniable log of their incompetence and contradictions. Third, he stated his position clearly and concisely. He wrote, "As per the terms of my policy, I am entitled to coverage for the damages sustained in this not-at-fault accident. The total cost for repairs, as quoted by a certified mechanic, is $7,452. I have attached the police report and the mechanic's estimate for a 4th time for your convenience." He didn't threaten. He didn't yell. He stated the facts of his policy. Then came the most important part. He made a demand. He wrote, "I expect a full and final response regarding the payment of this claim within 15 business days of your receipt of this letter. Failure to respond in a timely and fair manner will leave me with no choice but to file a formal complaint with the Ohio Department of Insurance and explore all other available legal remedies." Finally, the delivery system. He didn't email it where it could be ignored or sent to a spam folder. He didn't fax it. He printed 2 copies, put one in a folder for his own records, and took the other to the post office. He sent it via certified mail with return receipt requested. This is the critical step. For a few extra dollars, the United States Postal Service was now his witness. Certified mail provides a tracking number and proof of mailing. The return receipt is a green postcard that the recipient has to sign upon delivery, which is then mailed back to you. David now had a legally binding document with a person's signature and a date, proving that Direct Auto's corporate office received his letter. There was no more. We never got it. No more. It must be lost in the system. They had it. He could prove it. Checkmate. What do you think happened next? Did they ignore it? Did they lose it? Absolutely not. Within 72 hours of that letter being signed for at their headquarters, David's phone rang. It wasn't a low-level agent from the call center. It was a senior claims supervisor, someone with a title David had never heard of before. Her tone was completely different. There was no confusion, no runaround. She said, "Mr. Henderson, I'm calling in reference to the letter we received. I'd like to personally apologize for the delays you've experienced. I've reviewed your file, and it seems there's been some internal miscommunication." Internal miscommunication? That's the corporate code for "we got caught." She confirmed they had everything they needed and that a check for the full $7,452 would be sent via overnight courier. It arrived the next day. This wasn't magic. It was a fundamental shift in leverage. As long as David was just a voice on the phone, he was a nuisance they could manage and deflect. The moment he sent that certified letter, he ceased to be a nuisance and became a potential liability. That letter is the first step in building a formal case against them. It's Exhibit A in a complaint to the State Insurance Commissioner. It's the first document a lawyer would ask for. The people in the legal and compliance departments at these companies know this. Their job is to mitigate risk, and a well-documented, ignored complaint from a customer is a massive flashing red light of risk. They are forced to escalate it, to take it seriously, and, in most cases, to resolve it quickly before it grows into a much bigger, more expensive problem. It forces their hand, takes the power from them and puts it back with you. But this is where you have to be careful. Once you have their attention, once they know you're not a pushover, the game changes. They stop the stonewalling, but they deploy a new set of tactics. These tactics are much more subtle, much more sophisticated. They are designed to sound helpful, to sound like they're on your side. But their sole purpose is to get you to close your claim for less money than you are actually owed. They've stopped trying to ignore you. Now they're going to try to outsmart you. And the very next move they make is where most people, relieved that the fight is finally over, make their single biggest financial mistake. That move is the settlement offer. It arrives in a phone call, not an email. The adjuster who was impossible to reach for weeks is suddenly your best friend. They're apologetic about the delays, they're sympathetic to your situation, and they tell you they've been working hard to get you a fair number. And then they say it. A number that, after weeks of stress and silence, sounds like a miracle. $10,000, $15,000, $25,000. Whatever it is, it's the most money you've seen in one place in a long time. They tell you it covers your car, your medical bills, your time off work, everything. And all you have to do is agree. They can have a check in the mail by the end of the day. This is the moment of maximum danger. Your brain is flooded with relief. The fight is over. The money is coming. You can finally move on. You're so focused on the number they just gave you, you're not thinking about the numbers they're hiding. You're not thinking about the document they're going to ask you to sign. It's called a release of all claims form, and it is the most powerful weapon they have. Signing it isn't just about accepting a check. It's about forfeiting every single right you have to any future compensation for this accident, forever. And they are banking on the fact that you are too tired, too stressed, and too relieved to understand the catastrophic implications of what you're about to do. Let's talk about Amanda, a dental hygienist from Georgia. She was in a multi-car pileup on I-75. It wasn't her fault. A truck 2 cars ahead slammed on its brakes, and the car directly behind her, insured by Direct Auto, didn't stop in time. Her car was a mess, and her neck and back were in agony. For 6 weeks she played the game. She left voicemails that were never returned. She sent emails that went into a black hole. Her medical bills were piling up. She was using all her paid time off for doctor's appointments, and the stress was becoming unbearable. Then one Tuesday afternoon the call came. The Direct Auto adjuster was incredibly pleasant. He said, "Amanda, I am so sorry for the delay. We've reviewed everything, the police report, the photos, your initial medical statements. We see that you are clearly not at fault, and we want to make this right. We are prepared to offer you a total settlement of $18,500 to resolve this matter today." Amanda almost dropped the phone. $18,500. Her initial ER visit and follow-ups were about $4,000. The body shop gave her a first-look estimate of about $9,000 for her car. She'd missed about $1,000 in wages. In her mind, the math worked. $4,000 plus $9,000 plus $1,000 is $14,000. An offer of $18,500 felt like a bonus. It felt fair. It felt like they were even giving her extra for her trouble. The adjuster added, "We can overnight the release form to you, and as soon as we get it back signed, we will process the check immediately. You could have it by Friday." The promise of a check by Friday was the final push. She was exhausted from fighting. She was worried about her bills. She agreed. The form arrived the next day. She signed it, sent it back, and like clockwork, the check arrived. For a moment, she felt nothing but pure, unadulterated relief. The nightmare was over, but it was just beginning. First, the car. The body shop called a week later. "Amanda," the mechanic said, "we've got a problem. Once we got the bumper off and put it on the lift, we saw the frame is bent. It's not just cosmetic. This is a much bigger job than we thought. The new estimate is closer to $14,000. Suddenly, her $9,000 repair budget was short by $5,000. But she had signed the release. Direct Auto's obligation was finished. That $5,000 shortfall was now her problem. Then there was the diminished value. Her car, even perfectly repaired, was now a vehicle with a significant accident on its record. Its resale value had plummeted by thousands of dollars. The settlement included nothing for this loss. She had signed the release. That loss was now her problem. But the worst part was her health. The neck pain didn't go away. A specialist diagnosed her with a cervical strain that required months of physical therapy, twice a week. The copays, the deductibles, the cost of the sessions themselves, it quickly added up to thousands of dollars that her own health insurance didn't fully cover. And the settlement money? That was long gone, eaten up by the car repairs. She called the adjuster just in case. He was polite but firm. "Amanda, I'm sorry to hear you're still having issues, but by signing the release form, you agreed that the $18,500 settlement was full and final payment for any and all injuries, known and unknown, past, present, and future." Known and unknown. Past, present, and future. Those are the killer phrases. Amanda had settled her claim before she even knew what her claim was truly worth. She traded a fair settlement for a fast one. Direct Auto paid out $18,500 for a claim that was likely worth over $50,000, maybe more. They didn't just save money. They made a massive profit on her pain and her exhaustion. And it was all perfectly legal because she signed the paper. This isn't a rare story. This is the business model. The first offer is almost never the best offer. It is a test. It's a carefully calculated number designed to be just high enough to tempt you, but far, far below the actual value of your claim. Let's break down the hidden math they don't want you to see. When they calculate that first offer, they are intentionally minimizing every single category. For your vehicle, they're using databases that favor cheap, aftermarket parts, not the original equipment manufacturer parts your car was built with. They are deliberately ignoring diminished value unless you scream about it. For your medical bills, they are only looking at what you've already paid, not what you might need in the future. They won't offer a penny for future physical therapy, future surgeries, or the possibility of chronic pain. For lost wages, they'll count your base pay, but they'll conveniently forget about the lost overtime, the missed promotion, or the bonuses you would have earned. And the biggest category of all, the one they slash the most, is pain and suffering. This is compensation for the actual human cost of the accident. The physical pain, the emotional distress, the anxiety, the sleepless nights, the inability to enjoy your life the way you used to. There's no simple receipt for this, so it's where they have the most room to play games. A fair calculation for pain and suffering can often be a multiple of your total medical bills. If your medical bills are $5,000, a reasonable pain and suffering award might be anywhere from $7,500 to $25,000, depending on the severity and permanence of your injuries. In their first offer, they will likely offer you a fraction of that. Maybe $1,000. Maybe $2,000. They'll call it a goodwill gesture. They are betting that you don't know how this is calculated. They are betting that you'll see their offer, which includes money for your tangible bills, and you'll be so grateful for the little bit extra that you won't question how they arrived at it. Amanda's story is the ultimate cautionary tale. She was an intelligent, capable person who was simply put in an incredibly vulnerable position. The insurance company used her exhaustion and financial stress as leverage. They created a problem by ignoring her for weeks, and then they swooped in to solve that very problem with an offer that served their interests, not hers. They didn't break the law. They just broke her financially. So when that call comes, and it will come, and that friendly adjuster makes you that first tempting offer, you have to remember Amanda. You have to understand that you are in a negotiation, not a conversation with a friend. The number they are giving you is not a gift. It is an opening bid. It is their attempt to get you to leave tens of thousands of dollars on the table. Accepting it is the single biggest mistake you can make, because unlike almost any other financial decision, there is no undo button. Once you sign that release, the case is closed forever. The relief you feel from getting a quick check will last a week. The regret you feel from accepting a lowball settlement will last a lifetime. Amanda's financial fate was sealed the moment she put her pen to that paper. But what if she hadn't? What if, when that adjuster called with his best and final offer, she had said two simple words? Those two words change absolutely everything. They are the key that unlocks the door to a fair settlement and turns their entire strategy on its head. And knowing what those words are, and when and how to use them, is the most important thing you can do to protect yourself. So let's start with the first and most powerful phrase, one that insurance companies absolutely despise hearing from a customer. It's a concept they hope you never ever learn about. The phrase is, "I am filing a claim for the diminished value of my vehicle." That's it. 9 simple words. But what do they mean? Diminished value is the loss in your car's resale value, simply because it has been in an accident. Think about it. If you were on a used car lot looking at 2 identical 2022 Honda Civics, same mileage, same options, same color. One has a clean Carfax report. The other one has a report showing it sustained $10,000 in rear-end collision damage, even though it was repaired perfectly at a top-tier body shop. Which car are you buying? The one with the clean history, of course. And if you were to even consider the wrecked one, you'd expect a massive discount, right? That discount, that difference in value between the undamaged car and the one that was repaired, is its diminished value. And you are legally entitled to be compensated for that loss. Let me tell you about a customer named David from Georgia. He had a beautiful 1-year-old Ford F-150. He was meticulous about it. Parked in the back of parking lots, hand-washed it every weekend. One afternoon, a driver insured by Direct Auto runs a red light and T-bones him. The damage is significant, over $15,000. Direct Auto, to their credit, authorizes the repairs at a high-quality shop. When David gets his truck back, it looks perfect. You can't tell it was ever in an accident. He's relieved and thinks the ordeal is over. A year later, his family is growing, and he decides to trade in the F-150 for an SUV. He goes to the dealership and they pull up the vehicle history report. The salesperson looks at him and says, "Well, David, it's a great truck, but with this major accident on its record, the best we can offer you is $6,000 less than the trade-in value for a comparable truck without an accident history." $6,000. Vanished. Poof. That is money that was stolen from David's pocket the moment that other driver hit him. The repair shop fixed the physical damage, but they couldn't fix the truck's history. Direct Auto paid to fix the bent metal, but they didn't pay for the permanent damage to its financial value. This is why they fight diminished value claims so hard. A repair bill is tangible. They see an invoice for parts, an invoice for labor. They cut a check. But a diminished value claim is a check they have to write for a loss that is invisible. It's pure financial loss. So when you say the words, "I am filing a claim for the diminished value of my vehicle," you force their hand. You are telling them you know about this hidden damage. They can no longer just fix the car and close the file. They have to open a separate evaluation. They have to assign it to a specialist. Clogs up their system. And they know you mean business. They might tell you, "We don't pay for that," or "That's not covered in your state." But you just hold your ground because now you know the truth. Okay, that's the first one. The second phrase is just as important, especially if the repairs are going to take a while. The phrase is, "I am also making a claim for loss of use." Now your first reaction might be, "Well, doesn't that just mean a rental car?" And that's exactly what they want you to think. But it is so much more than that. Rental car reimbursement is one remedy for your loss of use, but it's not the only one. Loss of use is compensation for the inconvenience and the inability to use your property. Think of it like this. If someone broke into your house and stayed in your guest room for a month, you'd be entitled to compensation for them using your property, right? Even if you didn't have to go rent a hotel room. It's the same principle with your car. Let's take the story of Maria, a freelance graphic designer from Arizona. She worked from home, so she didn't have a daily commute. Someone insured by Direct Auto backs into her parked SUV, causing about 3 weeks' worth of damage. The Direct Auto adjuster calls and cheerfully says, "Okay, Maria, we've approved the repairs, and we can set you up with a compact rental car from Enterprise." Maria explains, "Well, I work from home, so I don't really need a car every day to get to an office." The adjuster, thrilled, immediately says, "Oh, great. That'll save you some hassle then. We'll just call you when your car is ready." And just like that, they're about to close that part of the claim and save themselves hundreds of dollars. But Maria had been coached. She replied, "I appreciate that, but I will be making a claim for loss of use for the entire period my vehicle is in the shop." There was a long silence on the other end of the phone. You see, even though Maria didn't need a car for a commute, she still lost the use of her SUV. She couldn't make a spontaneous trip to the grocery store. She couldn't drive to meet a client for coffee. She couldn't pick up her niece from school like she promised. She couldn't load up her art supplies and drive out to the desert for inspiration. Her freedom, her convenience, her property, it was taken from her for 3 weeks. The law recognizes this. By making a formal claim for loss of use, she forced the insurance company to compensate her for that inconvenience, typically in the form of a daily cash payment. It might be $30, $40, or $50 a day. For Maria's 21-day repair, that was over $1,000 she was entitled to, money she would have gotten nothing for if she had just accepted the adjuster's initial move to brush her off. So we have diminished value and loss of use. These are the claims you make. But what about the tool you use when they push back? This brings us to the third and perhaps most crucial phrase. It's not a claim, it's a challenge. When an adjuster tells you, "We don't cover that," your response should be a calm, polite, but firm, "I understand. Please provide me with the specific policy language that excludes this coverage." This is the ultimate checkmate move. Insurance adjusters, especially at high-volume companies like Direct Auto, are trained on scripts and general company policies. Their first, second, and third instinct is to deny, deny, deny. They operate on the assumption that you, the customer, have never read your 50-page policy and don't understand the law. And they're usually right. Saying "we don't cover that" is easy. It's a verbal dismissal. But asking them to show you the specific exclusion in the contract is entirely different. You are shifting the burden of proof from you to them. You are saying, "Don't tell me what your company policy is. Show me what our legal contract says." You're moving the conversation from a casual phone call to a matter of contractual law. Let's go back to David and his F-150. When he first filed for diminished value, the Direct Auto adjuster gave him the classic line, "Sir, in this state, we don't pay for diminished value on repaired vehicles." David, instead of arguing, just said, "I understand that's your position. Could you please email me a copy of my policy and point me to the exact article and section number that states coverage for property value loss is excluded?" The adjuster was stumped. He stammered for a moment and said he'd have to look into it. Why? Because in most cases, that specific exclusion doesn't exist. The policy will say they will pay to repair or replace the vehicle, but it's often silent on the issue of lost value. That silence is where your claim lives. By demanding they produce the language, you call their bluff. You expose the fact that their denial isn't based on the contract you signed, but on their internal goal of paying out as little as possible. It forces them to escalate your claim to a supervisor, or even their legal department, because you've just demonstrated that you're not an average customer they can push around. You are someone who understands that the policy is a contract, and you are demanding they honor it. These three phrases are your shield and your sword. They change the entire dynamic of the conversation, turning you from a passive victim into an active, informed advocate for your own claim. But what happens when you've used these phrases, you've made your case, and they still dig in their heels and refuse to pay? What's the next step? Because there is a next step. There is a single document you can send that will almost guarantee your claim gets taken out of the hands of that stubborn adjuster and put on the desk of someone whose job it is to avoid lawsuits and complaints to the state. And how you write that document makes all the difference in the world. It's called a demand letter, and it's not as intimidating as it sounds. In fact, it's your single most powerful tool. It's a formal written communication that lays out the facts, your argument, and your expectation of a resolution. It's not an angry email typed in all caps. It's a calm, professional, and devastatingly effective document that signals you are no longer playing their game. You are now playing yours by the rules of business and law. Let's break down exactly how you build this thing piece by piece so it can't be ignored. First, the format. Treat it like a formal business letter. At the top, you need a header with all the critical information. Your full name and address, the date, the claims adjuster's full name and address, and most importantly, the subject line. The subject line should be crystal clear. Demand letter regarding claim number, followed by your specific claim number. Right away, anyone who sees it knows exactly what it is and that it requires a higher level of attention. The first paragraph is your opening statement. It's a concise 1 or 2 sentence summary. This letter is a formal demand for payment regarding my auto insurance claim, number 12345, for a collision that occurred on October 26, 2023. That's it. No emotion, no long-winded story. Just the facts. You're establishing the purpose of the document from the very first line. Next comes the statement of facts. This is where you briefly, and I mean briefly, recount the accident itself. On the aforementioned date, I was driving northbound on Main Street when a vehicle insured by your company, driven by John Doe, failed to stop at a red light and collided with the passenger side of my vehicle. A police report was filed at the scene, report number 67890, which found your insured to be 100% at fault. Again, you're sticking to objective, verifiable facts. You cite the police report. You are building a foundation of inarguable truth. Now for the most critical part, the timeline of your interactions. This is where you methodically dismantle any argument that they've been handling your claim in good faith. You list every single point of contact or attempted contact. For example, October 27th, I filed the claim online and received an automated confirmation. October 29th, I spoke with adjuster Jane Smith, who stated she would arrange for an appraiser within 48 hours. November 2nd. Having heard nothing, I called and left a voicemail for Ms. Smith. November 4th. I sent a follow-up email. November 7th. Ms. Smith called back and offered a settlement of $1,800, despite my mechanic's estimate of $4,500 for the repairs. You detail every call, every email, every broken promise, every delay. Why? Because you're creating a paper trail. You're documenting a pattern of poor service. When a supervisor or a state regulator reads this, they won't see an impatient customer. They'll see a diligent policyholder being given the runaround by an unresponsive adjuster. This section alone often triggers an internal review. After the timeline, you move into the argument. This is where you directly challenge their lowball offer or their denial. And you don't do it with feelings, you do it with their own words. Get your policy document. Find the section on collision coverage or property damage. You're going to quote it directly. Your offer of $1,800 is insufficient to restore my vehicle to its pre-loss condition, a requirement under my policy. As stated on page 14, Section D of my policy agreement, coverage is provided for the cost to repair or replace the damaged property. The attached estimate from 2 certified repair shops clearly shows the actual cost of repair is $4,500. By quoting their own contract back to them, you fundamentally change the dynamic. You're no longer just a customer complaining about a number. You are a party to a contract pointing out a breach of that contract. You're showing them that you've read the fine print and you expect them to honor it. Now the demand itself. This should be a single clear paragraph. Therefore, I demand a payment of $4,500 within 15 business days of your receipt of this letter. This amount represents the lowest of the 2 estimates provided to you for the complete and proper repair of my vehicle, as per the terms of our policy agreement. Be specific. State the amount. Give a reasonable deadline. Finally, the closing. This is the part that gets you moved from the adjuster's pile to the supervisor's desk. It's the escalation clause. You state, calmly and professionally, if I do not receive a satisfactory response and payment within 15 business days, I will have no alternative but to file a formal complaint with your state's named Department of Insurance. I will also be forwarding this letter and all related documentation to my legal counsel to explore all available remedies for breach of contract and bad faith insurance practices. You see what you did there? You didn't threaten to sue them in an angry rant. You stated, as a matter of fact, the logical next steps you will be forced to take. You mentioned the 2 things an insurance company wants to avoid at all costs: official state complaints and lawsuits. The phrase bad faith is a legal term that carries immense weight inside an insurance company. It's a specific type of lawsuit that can result in massive punitive damages against them, far exceeding the value of your claim. Just using that term shows you know the game. You send this letter via certified mail with a return receipt requested. That way you have legal proof they received it, and when you don't email it, you don't fax it, you create a legal paper trail. In an overwhelming number of cases we've seen in customer forums and reviews, a letter like this works like magic. Suddenly, the adjuster who wouldn't return your calls for 2 weeks is replaced by a senior claims supervisor who is incredibly polite and wants to resolve this matter immediately. Because that supervisor's job isn't just to save the company money on your claim, it's to prevent your claim from becoming a much more expensive legal or regulatory problem. But what if they call your bluff? What if they still don't budge? Then you follow through. You go to your state's Department of Insurance website. Every state has one, and they are one of the most powerful yet underutilized consumer protection agencies in the country. Their job is to regulate insurance companies and protect policyholders like you. Filing a complaint is usually a simple online form. You'll fill out your information, the insurance company's information, and your claim number. And then you'll explain the problem. And what do you use for that explanation? You simply attach the beautifully crafted demand letter you already wrote. It contains the entire history of the claim, the evidence, your argument, and the company's failure to respond in good faith. When an insurance company gets an official inquiry from the Department of Insurance, alarm bells go off. These complaints are tracked. They affect the company's public complaint ratio and their standing with the state. A high number of complaints can trigger audits, fines, and even put their license to operate in that state at risk. It is a massive headache for them. They now have to formally respond not just to you but to their government regulators. The cost in man-hours alone for them to deal with a DOI complaint often exceeds the amount of money they were trying to save by lowballing you in the first place. We saw a review from a driver in Georgia who was in this exact situation with a subsidiary of Direct Auto. He was fighting for 6 weeks over a $1,000 difference on a bumper repair. The adjuster wouldn't move an inch. The customer spent an hour writing a demand letter and another 10 minutes filing a complaint with the Georgia Office of Insurance. 2 days later, a senior manager called him, apologized for the misunderstanding, and approved the full amount. 2 days. After 6 weeks of stonewalling. That is the power of escalating the right way. This entire process, from the structured letter to the state complaint, is about moving yourself from a position of weakness to a position of strength. You're taking control of the process and forcing them to operate on your terms, under the watchful eye of their regulators. You're no longer just a claim number they can delay and deny. You are a documented, procedural, and legal risk that is now cheaper to pay than to fight. But this whole ordeal, from the initial accident to potentially fighting for fair payment, highlights a much deeper truth about the insurance industry. It's not just about the policy you buy or the price you pay. It's about understanding the internal metrics and financial incentives that drive their behavior, from the friendliest sales agent to the most difficult claims adjuster. Knowing this is the final key to protecting yourself. It's the one thing that can help you avoid this entire nightmare scenario in the first place, regardless of which company you choose. And that one thing is understanding the fundamental, built-in conflict of interest at the heart of every single insurance company. It's the unwritten rule, the elephant in the room that dictates every interaction you will ever have. And it is this: the department that sells you the policy and the department that pays your claim are two completely different animals, often with completely opposite goals. Think of it like a beast with two heads. One head smiles, reassures you, and makes promises. Its job is to bring money into the company. This is the sales and marketing department. They are rewarded for growth, for signing up new customers, for making the process as smooth and friendly as possible. This is the face of the company you meet first. It's the agent who remembers your birthday, the easy-to-use app, the catchy jingle. This is the head that got all those positive reviews for Direct Auto. But the other head, its job is to guard the company's hoard of gold. This is the claims department. Their primary function from a business perspective is to minimize financial loss. They are rewarded for efficiency, for accuracy, and for paying out not one penny more than is contractually required. Every dollar they pay you is a dollar that comes directly off the company's bottom line. They are not your friend. They are not your advocate. They are the gatekeepers of the promise you bought. And this isn't to say they are all evil or that they exist solely to deny claims. But their incentive structure is fundamentally opposed to yours. You want the maximum possible payout to make you whole. They have a fiduciary duty to their company to pay the minimum required by the contract. This inherent tension is the source of nearly every horror story you've ever heard about insurance. The friendly agent who sold you the policy, they have zero power over your claim. They can't authorize a payment. They can't speed up an investigation. They can't overrule an adjuster. Calling them when you have a claims issue is like calling the restaurant hostess to complain about how the chef cooked your steak. They are in different departments with different bosses measured by different metrics. The sales agent's job was done the moment your payment cleared. Now you're dealing with the other head of the beast. So when we look back at the reviews for Direct Auto, it all clicks into place. The glowing 5-star reviews for easy setup, friendly staff, and great prices are all interactions with the first head, the sales and customer service side. They excel at this. But the 1-star reviews, the stories of frustration, denial, and endless phone calls, are all from people who had the misfortune of having to deal with the second head, the claims department. They had an accident. They needed the company to fulfill its promise. And that's when they discovered the friendly face they signed up with was just a mask for a much more formidable, bureaucratic, and unsympathetic entity. This is the Grand Canyon of the insurance world. The massive gap between the promise of the sale and the reality of the claim. And falling into it can ruin you financially. So, how do you protect yourself? How do you navigate this two-headed beast without getting burned? It comes down to a complete shift in how you shop for and interact with an insurance company. You have to stop thinking like a customer and start thinking like a risk manager. Here is your 4-step playbook. First, you must read the policy, not the brochure. The brochure, the website, the TV commercial, that's all marketing. It's designed to make you feel safe and secure. The actual policy document, that dense, boring PDF full of legal jargon, is the only thing that matters. That is the legally binding contract between you and the company. It is the rulebook the claims adjuster will use to decide your fate. You need to become a student of the exclusions and definitions sections. This is where the truth lives. Does it exclude business use of your vehicle? If you deliver pizzas on the side, you might not be covered. Does it define flood damage in a very specific way that might not cover your situation? You need to know this before you sign. It's like reading the instruction manual for a parachute before you jump out of the plane, not just admiring the cool picture on the box. If you don't understand something, call and ask for clarification, and this is critical. Get the answer in writing via email. Second, you must research the claims department, not just the company's sales reputation. Stop looking at ads and start looking at data. Every state has a department of insurance, and most of them publish what's called a complaint ratio. This number tells you how many complaints a company receives relative to its size. A company with a high complaint ratio is a massive red flag, no matter how cheap their rates are. Look for J.D. Power's annual claims satisfaction study. This is a direct ranking of how well companies handle the one thing you're paying them for. Read online reviews, but use the search function. Don't just look at the star rating. Search for the word claim, adjuster, accident, or denied. This will filter out all the noise from the happy sales process and show you the unfiltered truth from people who have actually had to use the product. Third, from the moment you have an accident, you must become the world's most organized and meticulous record keeper. The insurance company is. You need to be better. Your smartphone is your most powerful weapon. At the scene of the accident, before you even move the cars, take more photos and videos than you think you could possibly need. Get every angle of all vehicles involved. Get wide shots of the intersection, the street signs, the weather conditions. Get close-ups of the damage. If there are witnesses, get their names and phone numbers. When you speak to the police, get the officer's name, badge number, and the police report number. And this is the most important part. Every single time you talk to anyone from the insurance company on the phone, document it. Get a dedicated notebook. Write down the date, the time, the full name of the person you spoke to, and a summary of what was discussed. And then you follow up. You send a polite, professional email confirming the conversation. Hi, adjuster's name. Just to confirm our conversation today at 2:15 p.m., you stated that the rental car coverage is approved for up to 10 days, and that the appraiser will be contacting me within 48 hours. Please let me know if my understanding is incorrect. This creates a paper trail. It turns a he said, she said situation into documented fact. In the world of insurance claims, if it isn't in writing, it never happened. This one habit can be the difference between a paid claim and a nightmare of denial. Fourth and finally, understand your rights. Insurance companies are not all powerful. They are heavily regulated industries. You need to know the magic words. One of those is bad faith. If an insurance company is deliberately delaying your claim without reason, refusing to conduct a proper investigation, or misrepresenting the facts or the policy, they may be acting in bad faith. This is a serious legal violation that can result in them having to pay you far more than the original claim amount. You don't need to be a lawyer, but simply knowing that this concept exists and being willing to file a formal complaint with your state's Department of Insurance can suddenly make a non-responsive adjuster become much more cooperative. They know that state regulators are the last people they want to deal with. So what does this all mean for direct auto? The evidence we've seen, the stories we've heard, they paint a picture of a company that has mastered the art of the sale but struggles profoundly with the reality of the claim. It serves as a perfect real-world case study for the principles we've just discussed. The decision to choose them or any insurance company can no longer be about just the price. The cheapest insurance is the one that actually pays when you need it to. Your insurance policy is one of the most important purchases you will ever make. It's a promise. A promise that if the worst happens, if you lose your car, your home, your health, there will be a safety net to catch you. Your job, before you decide, is to look past the smiling face of the salesman and the catchy jingle on the TV. Is to investigate, to document, and to understand the game. You have to look that two-headed beast in both of its eyes and be prepared for the one that doesn't smile back. Because when that day comes, being prepared is the only thing that will protect you. What has been your experience? Have you ever had to fight an insurance company over a claim? Share your story in the comments below. Your experience, good or bad, could be the exact piece of advice someone else needs to see before they make a decision that could change their life. And if this video armed you with a new way to think about insurance, if it gave you even one tool to protect yourself and your family, do us a favor and hit that like button. It truly helps get this information out to more people who need to hear it. And make sure you're subscribed, because our next deep dive is into the hidden world of home warranties. And the truth behind them is something you absolutely cannot afford to miss. Thank you for watching. Stay safe and stay informed.